Good afternoon, everyone, and good morning to colleagues who view in from Washington, D.C. Greetings from Marrakesh. This is day 2 of the annual IMF World Bank meetings. Many important topics will be covered. Today, this morning, the World Economic Outlook of the IMF was released, setting the tone for the assessment of global economic growth in the meetings. Another important set of issues that will be discussed at this meeting and future meetings will be about the high debt burden and debt distress of vulnerable middle income and low income countries, and basically how to improve and speed up the debt restructuring process so that these countries can find a way to get out of their debt problem to resume growth in the future. So with me today, we are very fortunate to have 2 experts on this issue. Right on my left is Guillaume Charbet, Deputy Director of the Strategy and Policy Review Department of the IMF. And on our further left is Theo Marais, the analyst of the Sovereign Global Sovereign Advisory Company, and also expert on debt restructuring issues and problems. So let me begin the process by asking Guillaume, please give us an update on the whole discussion in the IMF World Bank circles, particularly within the Global Sovereign Debt Roundtable in the past 6 months. Any progress that has been made, any remaining problems that have to be tackled in order to improve the common framework for debt restructuring. Guillaume.
Sure, thank you, Hong, and thank you to the Atlantic Council for having me. Before turning directly to your question, perhaps taking one step back in terms of debt vulnerabilities, you mentioned that indeed they are elevated, and we, IMF and World Bank, are indeed concerned by the high level of debt vulnerabilities in low-income countries. As you know, 15% of low-income countries are already in debt distress, and another 40% are at high risk of debt distress. Around 1/5 of the emerging markets have spread beyond 1,000 basis points, and indeed there are high debt vulnerabilities. And a few countries have already undertaken a debt restructuring, and we know that the processes have been protracted, difficult, complex, and taken too long. So, as you mentioned, we launched the IMF, the World Bank, and India G20 presidency launched at the beginning of the year this global sovereign debt roundtable, which aims at gathering, the traditional price cap creditors, but also China, India, Saudi Arabia, the private creditors, and the borrowers, to find ways to have a greater common understanding on the technicalities for debt restructuring. We can go into more in-depth discussion, but yes, we've seen a good lot of progress over the past 6 months on how to treat domestic debt, how to account for the debt owed by state-owned enterprises, what is the role of MDBs, how to assess comparability of treatment, many aspects where we've seen good progress. On Thursday, there will be another meeting of the GSTR, and we intend to issue a progress report to put in the public domain all of this progress.
Right. When you say progress, what do you really mean? You mean agreement on the substance of the issue, like comparability of treatment, or agreement to disagree?
So typically comparability of treatment, which has been one of the difficult issues, how to assess and enforce comparability of treatment between the official bilateral creditors on the one hand and the private creditors on the other hand. I think now we have clarity on how the official bilateral creditors would implement COT, what is the formula they would use, what is the discount rate they would use, what is the mechanism to enforce this comparability of treatment. I think it would be fair to say that the private creditors would think that the discount rate used by the official bilateral creditors, typically for low-income countries, it would be the 5% discount rate of the low-income country debt sustainability analysis framework. They would see that as too low to estimate the effort of the private creditors, but at least there is clarity on how it would be done.
Well, for the benefit of viewers who are not familiar with the terminology, comparability of treatment means that the degree of debt relief granted by official creditors and by private sector creditors should be comparable. Not exactly equal, because each one look at it from a different perspective, but comparable. And that is where some disagreements still come in, because how do you define comparable is really up to where you sit.
If you can allow me, you are perfectly right. This idea of comparability of treatment seems natural, right? Fair burden sharing.
Right.
Now, when you talk about how to do that in practice, it's just a nightmare.
Phil, from a private sector practitioner advisor's point of view, what do you think? Is there enough progress in the roundtable? If not enough, what else needs to be put on the table? What else needs to be tackled?
So thanks for having me today on the panel. Very happy to be here with you guys in Marrakesh. Taking a step back, like Guillaume, in terms of debt vulnerabilities, I think it's important to flag that debt vulnerabilities have increased across the board. And even we might not see a string of debt defaults and debt restructuring, it's important to see that the debt service, the burden of servicing the debt, is increasing in a lot of low-income countries. And this comes at the expense of other spending, other expenditures, especially development expenditure, social expenditure. So even though we might not have a string of, classical debt crisis, we might still have a development crisis that would materialize at a later stage. A quick point on the GSDR. I think everybody was surprised when this forum was created because it was not an official institution. It had no clear mandate. It could have been handled at the G20. It could have been handled at the board of the IMF. So many people, and myself included, were skeptical. I think in the end, this skepticism has been replaced by, hopeful optimism. I would say, as Guillaume has said, it seems like people actually needed a safe space to just discuss all the ideas that are not even open to discussion in the other forums. When you're at the G20, you don't have time to discuss whether MDBs should participate in debt restructurings. You don't have time for these things, and they end up just under the carpet. And it was important to just have this space to say, okay, this is where I'm coming from, this is how I view things, and to make progress on the technical points where actually everybody has an interest in having more clarity, in having some more clarity on how things work. I would just cite cut-off dates, the exclusion from restructurings of short-term trade credit. We don't want to suffocate the economies of countries just after the default, and so I think it's important to have everybody come to the table and, as Guillaume said, go into the detail of this is the discount rate, this is the date, this is all these very technical things. Now we enter to the next step. Once we are done with the technicalities, there are still some big issues, and you cannot disentangle the restructurings from the broader geopolitical discussions. I think it's important to frame the debt issues in the face of the IMF governance reforms, World Bank governance reforms, and these issues won't be able to be tackled at the GSDR, so we also need to think ahead in terms of the broader challenges.
So those kind of issues will not be handled or discussed within the context of the Global Sovereign Debt Roundtable. But where can they be tackled? Where can they be discussed? In the IMF board, the World Bank board, G20
Can I
summits?
jump in on that one?
Yes, sure.
Definitely.
I think I totally agree with the description that we may not see a large wave of debt restructuring and debt
Right.
default, but we have indeed the development challenge, a liquidity squeeze, a funding squeeze. And that's where I think, I don't know, of course, it will be far too to say, but I think part of the answer is all of those efforts that are being done to scale up concessional finance,
Right.
the evolution roadmap at the World Bank, which is extremely promising. There was this review of the capitalistic framework of the MDBs done by the G20 to not only as the World Bank but also as other MDBs find ways to scale up concessional finance, scale up the risk mitigation
Right.
to crowding private finance. So at the end of the day, I don't know if it was what you had in mind, but I think the combination of domestic reforms, mobilizing domestic revenues, both private savings and tax, and supporting countries through appropriate international support, including debt relief where needed, that's the appropriate combination. And of course, those issues will not all of them be discussed at GSDR, which is really centered on that. But you will have to reconcile the different angles, I think.
Yeah, what I had in mind more specifically is that when you look at, for example, on the IMF governance and the link with the debt restructuring issue, you had remarks, for example, recently by Jay Chambeau, Assistant Secretary for Undersecretary for International Affairs at US Treasury, who said that basically for the US to accept an increase in the share of China at the IMF, they would expect China to become more transparent about its lending, to participate in a multilateral setting in the restructurings, and to be transparent about FX management and interventions. So you see that these issues are linked, and there's only so much that Guillaume can do at the GSDR. Then it needs to go up the agenda among the world leaders, be it at the board of the IMF or the G20, for instance.
That's a well-taken point. You both mentioned several items discussed in the roundtable, one of which is the role of the multilateral development banks. So what kind of agreements that have been reached in the roundtable vis-a-vis the role of MDBs in the debt restructuring process?
So I think on this one, a very, very turning point was in April, right, at the first meeting of the principles of the GSDR, where there was an agreement that the right way for MDBs to support countries undertaking the debt restructuring is to provide new flows of grants and concessional financing. So you have these statements coming out of the April meeting saying that the role of MDBs is need to provide net positive flows, right, of concessional finance and grants. Now, of course, I would think it's fair to say that the discussion on what is the amount, right, that is provided is still under discussion, has always been, right? But that's a turning point. I think the discussion has moved on that.
And that was turning point in the sense of allowing China to participate and to join in the round table and start a discussion. But from a private sector point of view, is that enough? Is that adequate in terms of MDB's involvement in the debt restructuring?
So I think these are my views and my personal views only. I cannot disclaim that strong enough. And I'd say I don't think the right way to go with this issue is to cancel the debt of MDBs or to make them give haircuts for several reasons. Two reasons. The first one is that these countries need debt, in fact, to finance their development, to finance the fight against climate change. And the best debt for these countries to do so is MDB debt. So as long as they still have room for MDB debt while being under the debt sustainability thresholds, I don't think we should cancel MDB debt and replace it with commercial debt or more expensive debt. And the second point is that I don't think MDB debt relief is really what is holding the deals right now in the countries, and we can discuss this a bit more. I think if you look at the mathematics of the available cash flows, the MDBs are not, they are so cheap, so long term that they are not the ones who are capturing all the cash flows and that could really make a difference in terms of achieving debt relief from commercial creditors or official creditors.
So what is the key factors that are holding up the progress of that restructuring process, make it lengthy, opaque, very time consuming and really causing losses for everyone concerned? So what is holding it up?
So perhaps on that one, just to mention, because your first question was the progress we have made or not made, right? So let's start by the conclusion, which is, it took 11 months in 2021 for Chad to get from the staff level agreement, which is a point in time where the staff and the authorities reach consensus on the program parameters. So 11 months from staff level agreement to the program approval, going through the process of getting the financing assurances from all the regions. 11 months in 2021. 9 months for Zambia in 2022. 6 months for Sri Lanka in March 2023, 5 months for Ghana in May 2023. It's beyond the 2 to 3 months that we had in the past, and that should be the target because we need to act fast in that phase of the crisis, but it's progressing, right? From 11 months to 5 months, I think that's a progress. And that addresses your question. The key impediments we've seen typically in Chad or in Zambia are the discussion on the role of MDBs, the compatibility of treatment, which wasn't clear at all, frankly, in 2021 and 2022. How to treat domestic debt, how to treat SOE debt. All those issues, I think it's a fair description to say that indeed the GSDR provided a safe place to have those issues. Not to say that we agree on everything, but at least it can be discussed.
I think also sovereign restructurings are a zero-sum game, and creditors, when they want to get their money back, they will look at all the ways to move the needle. And so we cannot be sure that we have a comprehensive list of the potential problems, because anytime there's a new country, you will find something new. And in Sri Lanka, it can be the pessimism of IMF economic forecasts that creditors don't like. In Zambia, we can go into it. It can be non-resident holdings of domestic debt. And so it seems like these problems, they keep appearing whenever we have a new case. So it's more about, I think that's where the importance of the GSDR can be, to have whenever we have a new problem coming up, and there will be, we have this forum where we can come together, discuss, and have a common understanding.
We will get into the particular lessons to be learned from the Zambian debt restructuring process and also the current one for Sri Lanka. But before we get there, I just want to finish up with the discussion. You mentioned both about domestic debt. So my question to you both is that what should be done? Should domestic debt be included in the envelope of debt to be restructured or not? Because there's, in my view, pro and con on either way you want to argue the case. But start with you, Guillaume.
So typically, that's another example where indeed views are super diverse, right? Some would say ex ante by definition and by default domestic debt should be excluded. Others would say no, it should be included. And I think one of the merits of having all the views around the same table is precisely that people realize, okay, maybe my view is not the right one, right? So I think we had the workshop on September the 15th with many participants from borrowing countries, from the private creditors, from the different official bilateral creditors, from the CSOs, from the advisory experts, tech experts. That was super interesting. And I think we see this growing consensus that, in fact, the answer to your question is it depends. It depends on the data. It depends on the country. What is true in Sri Lanka may be wrong in Zambia. And I think the consensus is what you need is to do scenario analysis. So not come at the table saying domestic debt will be ex ante excluded or ex ante included, but just do scenario analysis. What is the impact of including domestic debt on financial stability, on growth, and ultimately on the capacity to repay, including the external creditors. And it depends dramatically of the specificity of the countries in terms of financial sector, in terms of holdings, etc. So basically having scenario analysis and for the authorities to convince their creditors that the scenarios they choose make sense.
I can see that in the IMF, it depends is a very good way to get unanimous agreement on many questions. But still, what do you think?
Yeah, I think I have a lot of sympathy for the handle with care approach of the IMF. Guillaume mentioned the impact on financial stability, on economic growth. I would add maybe the impact on the social fabric. And I think an important aspect is that domestic restructurings, populations on the ground are already suffering from the economic crisis that usually comes with a sovereign default. They are exposed to their government not only through the debt aspect, but also through the provision of social health care, of education. And so we need to take this into account. And when it is assessed that domestic debt should be restructured, it should be included from the start in the design of the IMF program specifically, and to ensure that you have the adequate social safety nets that come as a way to alleviate the impact on the domestic population. But I think a separate but linked debate is also how the current architecture for sovereign debt restructurings creates incentives to restructure domestic debt where maybe it wasn't necessary, or to restructure it not in the right way. If we look at Zambia, for example, the IMF's low-income country debt sustainability analysis is conducted on a residency criteria. So, long story short, you had a lot of debt that was in domestic currency, domestic debt, but which was held by foreign residents. It was added to the external DSA, and so it created an incentive for external creditors to ask for a domestic debt restructuring, not because it was needed in absolute terms, but more because it would enable them to have more available cash flows to service their debt. And we had a similar problem in Sri Lanka, where the combination of some IMF debt targets created an incentive to basically execute a domestic debt restructuring that would mostly be designed around the ability of the government to maximize foreign debt service.
Well, I mean, it's good to hear from you that you think that there is sufficient progress moving forward on many fronts. But on the domestic versus foreign debt, I think your answers have not really satisfied me in terms of my own sense that at the end of the day you have a debt restructuring, particularly so that you can add net new resources to the country to help it grow. And only restructuring the external debt can you effect this net transfer of resources from outside of the country, from foreign savers particularly, to the country. Whereas you do that restructuring of domestic debt, you just move the losses from the public pocket to the private pocket. You don't add any new resource to the country as such. And therefore, restructuring domestic sovereign debt defeats the original purpose of that restructuring.
So I understand where you're heading. Just perhaps by way, I was saying that we've seen a lot of progress, in particular in ongoing restructuring. Again, the last 6 months, we've seen move on Sri Lanka, on Ghana, on Zambia, on Suriname. So that's positive. Are we done? No. There is still a lot to do, right? Just not to have a misunderstanding here. We still see a lot of things to do. Just perhaps, I see your point on domestic debt restructuring, but perhaps to rebound on what Theo mentioned on Zambia. Typically, I think this discussion on Zambia and on the non-residence holding of domestic debt, which creates outflows, right? Because the country has to repay non-resident even though it's in local currency and in local government law issued bonds, right? There was this discussion, and at the beginning, I think both the bondholders, external bondholders, and China, to be very direct, were not of the view that the non-resident holder of domestic debt should be exempt from the restructuring, because ultimately Zambia, indeed, there is no domestic debt restructuring. And since there is no domestic debt restructuring, there is no inclusion of the non-resident holder of domestic debt in the perimeter. That was a very good discussion. I mean, it was bad because it took long, right? It was protracted. But I think exactly as Theo mentioned earlier, it's helps shape the consensus for future cases. That is not as simple as it seems. And you also have to find an agreement at some point, right? You have to find an agreement with the creditors. So you have to make the case, basically. And in that case, the authorities could make the case vis-à-vis the external creditors that indeed domestic debt should be exempt.
So to conclude this part of the discussion, in your view, what is the one or two key issues that needs to be discussed in the roundtable here and going forward? We have made progress in the past. Several issues have been tackled. So what are the next one or two issues that you think are very important to be touched?
George, is that?
Yeah, I feel like some more discussion is needed if we think about comparability of treatment. For instance, like it could take months, if not years, until we have a final progress. Other issues could be around the impact of climate change on debt sustainability, right, and how the DSA maybe should be conducted. But there's also the IMF incoming review of the debt sustainability model, and maybe we have a broad range of liabilities that are coming up in restructurings. You can have arbitration proceeds, you can have central bank swaps, and we are not really well equipped to deal with such complex liabilities and their impact on broader issues. So maybe that's one thing that will be discussed at the TSDR as well.
So from my side, I think there are two kind of topics, right? One is going one step further in terms of common understanding of the technicalities for efficient debt restructuring. I think, again, we did a lot of progress on domestic debt restructuring, where to do that, when to do that, how to do that. On the use of state contingent debt instruments, what's used in the case of Zambia could be used in other cases. Theo mentioned cut-off date, short-term debt, exclusion, etc. All of that, I think there is good progress. Typically, I mentioned at some point the issue of state-owned enterprise debt. Should it be included or not? How to account for SPV debt? You have a dam financed by a certain type of project finance. Should it be included or not? Because the project may be commercially viable. I think here that's a typical example where there is a very, very low level of understanding on how we should account in terms of debt sustainability analysis of those debts. That's an issue where we should progress. The second part is, moving a bit away from the restructuring per se. I completely agree that taking more into account the climate-related issues in all those analyses of debt vulnerabilities, that's absolutely key. And indeed, we launch the review of the linked DSF, that will be part of it, a major part of it. I think in terms of preventing the build-up of debt, I mean, we may be at the end of the first cycle of restructuring, but technology is still high, right? So how do we move that needle forward? There is still a lot of work in that area for sure.
Theo, you mentioned something very important which we have not touched on yet, climate change and the impact of climate change or relationship between climate issues and debt restructuring. There have been various proposals being put forward to link the two. For example, debt for climate swap or debt for nature swaps. As part of the restructuring, mainly creditors agree to give substantial relief to the debtor country with the commitment that proceeds will then be applied and used for climate mitigation projects and so on. What do you think? Is that a good idea? And if so, what needs to be done to make it a reality? Both of you.
Well, debt for climate swaps are a very complex issue. I think we saw them back in the 80s with bilateral creditors in the wake of the Latin American debt crisis. It was just bilateral creditors cancelling some debt in exchange for some new environmental expenditure. Yeah. And now we see a new form of such debt for climate swaps, which involved complex debt instruments, SPVs as mentioned by Guillaume Chabert, and some complex financial engineering. I think the baseline on this is that in the end, no complex and magical financial engineering can make the risk disappear. So these transactions are about inflicting some losses on someone or putting the risk somewhere else, and we need to be very transparent about it. And I think the way these transactions have been structured in recent years has been too complex, too expensive, not transparent enough, and we need to do more on that because it can be very positive in the short term and you have the announcement and you create the momentum around it, but we should be careful that these transactions do not create fiscal rigidities in the debt stock or legal complexities that would come back to bite if 10 years from now, 15 years from now we have another debt crisis.
So if I understand you correctly, you think that the principle is great, but the details are really a problem and the complexity will really make the concept difficult to implement.
Yes, I think a debt for climate swap should be, I cancel some debt and in exchange the country spends more on the climate. And when we try to make it so complex so that nobody is actually taking a loss, then maybe the loss is just hidden somewhere and we will find it at a later point.
So a bit similar but a bit different. The way I would see it is probably here too, it depends. I mean, there are cases where probably that's a good idea. Now, is that the silver bullet to resolve the debt crisis and the climate crisis? Probably not. What I mean here is that we had, in July 2022, we had issued a working paper, to illustrate, that typically from the creator point of view, providing the debt swap is basically equivalent to provide a grant, right? And in a restructuring context, if you want to reduce the debt burden because the debt is not sustainable, maybe that's not the best case where you could use this debt swap operation, right? Because in the first place, you want to restore debt sustainability. And using one instrument to tackle two objectives may not work. Now, outside of pure unsustainable debt situation, it may work. And what would be needed, and that's where perhaps we say the same thing but with different words, would be to have some form of guiding principles. And that's where indeed the GSDR may help, right? To create some common understanding among all stakeholders on where and when to use these instruments and how to do that if it's used. Another angle is, of course, the use of contingent clauses, climate contingent clauses to anticipate situations where you have a climate event. On this, I think there has been a lot of progress. Now it's time to move to implementation phase, of course.
I think Guillaume's point is very important in the sense that when you have a sustainable debt but high fiscal risk and climate adaptation is very efficient, this is the very small subset of countries where we should push instead of trying to throw it into any restructuring negotiation to push a deal forward.
Very good. So I think it's time to move now from the theoretical level to more concrete, detailed, practical levels. We have had, like you say, several debt restructuring making progress, and one in particular, Zambia. We had the Zambian Minister of Finance earlier here with us and for discussion, and he mentioned that he's looking forward for a conclusion with the signing of a MOU soon. He said he could not give an exact date, but he said soon. So with that in mind and with the parameters of the deal already specified in Paris back in June, and I understand that there's no change in the parameters agreed in June in the final MOU, what is the lessons that we can learn from the process that lead up to the agreement, the content of the agreement, the different parameters, the NPV haircut, the extension of maturity and so on? What are the lessons that we can learn to use for other countries or to avoid when approaching debt restructuring discussion with other countries? Leo first and then Kilo.
I think the first lesson from the Zambia deal, or what we know of it at least, is that official creditors can come together to provide meaningful debt relief. And we are talking about 1% interest rate on the debt for the period of the program, climbing up to barely 2% or something, and 12 years average maturity extension. It's not the delay and replay kind of restructuring that we might have been used to before. And if 4 years ago or 3 years ago we said that China would come to the table and sign a deal alongside the Paris Club, Guillaume, who was at the Paris Club at that time, I think wouldn't have believed it. And so I think it's important to commend all the elbow grease that the Paris Club, the IMF, the Chinese, the Indians have put out over the past few years in trying to come together and have a common agreement. That being said, this agreement also required to accommodate China's vision of its official sector. China's overseas lending is done through a somewhat fragmented landscape that involves, the central bank, the Ministry of Finance, the Ministry of Commerce, the policy banks, China Exim and China Development Bank, but also the state-owned commercial banks like the Big Four, like ICBC, BOC, etc. And in the end, all these institutions are owned by the state. They have leaders that are approved or nominated by the state council and the central government. So they could be loosely defined as the official sector, as it would be in other Paris Club members. But it seems that there was an initial acknowledgement that commercial Chinese claims backed by an export credit agency, Sinosure, which is also an official body, would be included in the deal in Zambia. And in the end, to make a deal, it appears that these claims needed to be reclassified as commercial claims, and they will be treated through the comparability of treatment principle at a later stage. So we still need to grapple with the fact that China doesn't define its official sector like other creditors do. Another lesson is that, and final lesson is that the IMF DSA, debt sustainability analysis, has become a focal point in the negotiations. It's supposed to be the bedrock of the negotiations, but it became an important point of discussions, of debate. We can list many factors of the discussion, but I think the two main ones are the debt carrying capacity and the threshold effects implied by the IMF indicator, which modifies the thresholds that define sustainability, and also the way that the IMF accounts for non-resident holdings of domestic debt, as we mentioned. And as Guillaume says, non-resident holders of domestic debt, they can create pressure on the reserves. But the principle of the DSA is to look at the maturity structure and the redemptions over time and the debt repayment schedule, and maybe we could say that the way to assess the impact of non-resident holdings on debt sustainability is not to look at the maturity structure, but at the potential for short-term outflows compared to reserves. And in that sense, maybe they shouldn't have been included in the external DSA like any other Eurobond or Chinese loan.
So look, I think I would start by saying that this example of Zambia has been described as a test case. I think that's the first ever, restructuring. You mentioned that's unify China, India, Saudi Arabia, and private creditors as well. Of course, we had Chad in December 2022, but that was a small case. It had also its complexities, because on the private sector side it was collateralized debt, which was complex. But I think it was nothing like Zambia in terms of complexity of the restructuring, in terms of test case, right? And the test is positive. It worked. For the first time ever, you had the entire collectivity of the official barter creditors working together. And indeed, there was a lot of work, in particular from the co-chairs, China and France, co-chairs of the official creditor committee. They worked a lot. It took too long. Clearly, I think it was super painful for the country and its people, right, that it took too long. But there was a learning experience which can be replicated elsewhere. That's the first point. While recognizing that each case is different, I think that's something which is important, in particular to the Chinese lenders. They don't want to see or to describe the Zambian experience as a blueprint. It's not as if what has been done for Zambia would be just replicated elsewhere, exactly the same, which I think is a fair point, because all those cases in the past, apart from the HIPIC initiative, right, all of the other cases about HIPIC initiative were also case by case each time. The second thing is, again, even though it took long, was protracted and painful, key elements have been clarified. COT, the comparability of treatment, now it's very clear how the official barter creditor intend to assess, so what is the metric, and how they will enforce. You mentioned that the parameters of the agreement were formed in June. So why don't we have the MOU since June? What happened, right? And I think the only thing which didn't happen, or took a bit longer than expected, was precisely what would be in the MOU in terms of the legal rule, if you so wish, for the comparability of treatment. And they are about to find an agreement, it seems. So that's something which, is something which can be replicated, that one at least. And the second thing is this innovation that the official barter creditors use for Zambia, which is the use of state contingent instruments, right? Because there are uncertainty about the future. To help narrow the bridge between the debtor and the creditors, there is this use of the state contingent approach, which is entirely defined example with two scenarios in the future, scenario A and scenario B, if you so wish. So everything is determined example with automatic triggers, but it helps narrow the gap. And that's also super innovative. I don't think there is an example in the past history of the Paris Club, for instance.
Now, let me push back a little bit to your quite positive assessment of the Zambian case. Number one is the Chinese insistence that they would not accept any nominal reduction of the cash, the face value of the bond, of the debt. So no nominal haircut, only NPV haircut, net present value haircut, in the sense that you extend maturity, you reduce interest rate. Is that sufficient? Because nominally the debt load is the same. And the way the IMF calculate the debt ratio is nominal debt divided by nominal GDP. And if nominal debt is stay the same, no haircut, the debt burden is still there in debt GDP ratio terms. That's number one. Number two, the contingency that you mentioned is the debt carrying capacity of Zambia going forward. And in June of this year, for many analysts, even for a retired person like myself, looking into the situation, it is clear that the IMF will revise upward or improve the debt carrying capacity of the country with the economic assessment and forecast that you presented. So 4% growth this year, 4.2% next year, debt carrying capacity will be improved, in which case the concession that Theo, you mentioned, 1% interest no longer apply. It will go quickly to 4%. Maturity extension 12 years, no, not 12 years, but be shortened. In fact, the deal was perceived by market participants as very generous to creditors, to the extent that the Eurobonds of private sector of Zambia rally after the news in June. So is that too generous for creditors?
So maybe I start? So look, on the nominal haircut versus PV reduction, as a matter of fact, Zambia being a low-income country, we use the PV value of debt to GDP ratios, and all the ratios are done using PV values. So in terms of debt stability analysis, it's equivalent to have PV reduction, or to have PV reduction or to have nominal haircuts. And if you look at the past history of the past 4 or 5 decades, typically Paris Club treatments, apart from HIPIC, there are only a few cases where indeed it was done through nominal haircuts. I mean, most of the time it was indeed PV reduction through maturity extension, reduction of interest rate, grace period, etc. So I think it's a bit, the criticism would be not to China, but rather to the broader set of official battle creators, Press Club or not Press Club, I think. Now, in terms of is the deal too generous or not? Well, first of all, the IMF doesn't take a view on the intercreditor equity, right? As long as the ratios are met, we are just saying that the SA is met, and that's the case. Good. I think in terms, if I take one step back and give my hat off, I think when you have a better situation, be it improvement in the debt carrying capacity or improvement in the growth or whatever kind of economic metrics, it's just a question of here too, what is the fair burden sharing, right? Between what remains in the hands of the debtor versus what should go to the hands of the creditors. So it's not unfair, I think.
Yeah. I think I would just say that specifically, when you do a state contingent deal, it's very important that the trigger for the state contingent deal is directly linked to the actual ability of the debtor country to repay. And I'm not sure here it's the case, because if we look at the debt carrying capacity, it takes a lot of economic variables into account, and not only historical values, but also forecasts up to 5 years. And so you could have a scenario where suddenly the IMF forecasts more growth in China or the US 5 years from now. It will have no impact on Zambia's direct ability to service debt, but still the payments would accelerate, and I think that's a scenario we'd like to avoid in an ideal world.
Can I jump on that one? Because I think apart from state contingency, that will be the case in any sustainable analysis. I mean, the reality is that the growth of Zambia, all the elements we put
fair enough. Yes.
Yeah, so it's broader than that. We are making projections, but we may be wrong.
Well, I raised the question because when I was still involved in sovereign debt restructuring, normally for a low-income country like Zambia, the end result is closer to 50% PV haircut rather than 40%. So that's why I have some nitpick about, is that enough for the country? But let's move on. Last question on Sri Lanka. Any quick take, very quick, because we are running out of time. Sri Lanka, anything else that needs to be done?
Just one quick point on Sri Lanka. I think it was done with the IMF's market access country debt sustainability analysis, and we had kind of the opposite problem as in Zambia, as in I think the targets are a bit too loose. We can back engineer basically that the IMF's targets and macro framework imply that Sri Lanka will be spending a third to half of its revenues on debt interest payments going forward for the next 10 years or so. And I think you can have the best models ever with the best econometric model, etc. We shouldn't forget common sense, and it's not sustainable for a country to be spending half of its revenue on debt service period. Yeah.
Great. Common sense is a great quality to have. Guillaume.
Yeah.
Very briefly, so Sri Lanka, and is a complex case, of course. As you know, there is discussion on the first review program, so that's not the debt restructuring part, but really the policy implementation and the program implementation phase part. I think the point I would like to make is, I think for Sri Lanka you have 10 parallel discussions if you take into account the different creditors. So whatever criticism we can do and make with the common framework, and there are lots, and rightly so, I think at least it helps those countries like Zambia or Ghana to have all the official bilateral creditors in the same basket, right? Discussing with one creditor committee. So I think in terms of progress, for those countries that are not yet covered or eligible to the common framework, improving creditor coordination, in particular between China, India, Saudi Arabia, and Paris Club creditors, is absolutely critical.
Great. So with that positive assessment, we will conclude the program. And thank you very much both for your very detailed, knowledgeable comments and explanation of the process. And I hope that with that we can better understand what will happen in the next few days in terms of further development of the common framework. Thank you very much.
Thank you very much.
Thank you for having us.